Welcome to another edition of Pizzichetta. My name is Pizzichetta, founder of Mont Wealth, and today I'm joined by an old friend and still a friend, Gino Rossi, founder and portfolio manager of Vestigo Investments and the architect behind the Vestigo Investments Discovery Fund. Welcome, Gino.
Thank you. Still friends. I need to try harder.
You are a Fremantle supporter. You're up and about at the moment. The team's doing quite well. But Vestigo is a global small and mid-cap strategy built for intergenerational wealth and the needs of sophisticated family offices. Now, I know a little bit about your philosophy, so we're going to talk through that today. But in this conversation, I would pick your brain a little bit on the macro environment, which is shaping the markets today. We'll dive into a bit more of your investment process and risk framework, and then the opportunities emerging in global small and mid-cap stocks. But as I always do before we get started, I need to make the listeners aware of the general advice disclaimer. Anything we discuss today is general advice only. Anyone acting on this advice without written and agreed consent from a financial advisor like myself does so entirely at their own risk. So, Gino, officially welcome. Tell us a little bit about yourself, how you set up Vestigo and your experience in financial markets.
So, I grew up in Fremantle, in WA. Liked the share market. I got into the share market in my teenage years. Found it just very interesting. Dad's blue collar, but has owned shares he actually worked on North Rankin A off the Northwest Shelf there when they built that. And someone on the North Rankin A said, I should buy some Woodside shares. I think they were $2 at the time. And that sort of got him interested in shares. And I thought it was just so exciting. So came to Sydney to pursue this sparkly career. Started with Credit Suisse. So I've worked for growth funds, I've worked for value funds, I've worked in large caps, small caps, global. I've spent time on the sell side with you, Rob, at Citigroup for 5 years. Yep. And I've also spent some time in corporate strategy for ASX 500. So I've seen the market from various angles. And rightly or wrongly, I'm a baby born of the dot-com GFC era. So I'm always looking at risks and worrying where to come a 40, 50% drawdown, which has been a bad way to be. I was last at Pinnacle, ran a global micro fund, which I thought was spectacular. It was actually one of the best, if not the best performing small cap funds, global small cap funds out of Australia. Yeah. And I was approached by a friend and someone very wealthy to start my own fund. And I decided yes, because I really trust and like the person. And I thought, okay, great. And I'm going to design it specifically for people like you. I'm going to design it for people who have money that they're not worrying about retirement. They're worrying about a legacy. They're worrying about what I do with this money. I'm going to pass it down to our kids or an endowment, charity, whatever it is. This money's going to outlast me. So I said, let me design something specifically for people like that, because I don't think there's a product out there that actually addresses that. And that's effectively the genesis of Vestigo. I think I've got the experience and I think I've got the capabilities. And we started the fund from nothing. We've got the trustee and the unit trust and systems in place. And now it's about building a track record. We've been going since November 24.
And before we do get into the fund specific and some of the stocks, we always love chatting macro, big picture stuff.
Yeah.
So how would you view the current market environment at the moment that investors are facing?
There's some charts you want me to share. So as I said, the fund is built for intergenerational wealth. So in macro, one of the things that I really like to follow is a thing called CEO Economic Confidence. And it's available for free. They're put out by Chief Executive Magazine. And you can see it's got a really long history, back to 2002. And it tracks the MSCI really well. And what we saw with the tariffs was the CEO confidence absolutely cratered. The CEOs were really worried about the APEC tariffs. And then over time, as you can see, they're like, okay, we get it. And now their confidence is back up again. So CEOs have learned to taco. And I think this is one of the best leading indicators of the market. It's about a 4-month lead on the market. You can see it's generally been a very good lead. So when CEOs start to worry, the market eventually catches up.
Yeah. But now they're actually quite optimistic on the outlook.
Quite optimistic because they know Trump's got their back. Yeah.
Yeah. Okay.
Dr. Copper, again, this is more a coincidental indicator. Generally, you'd like to see copper go up with the market, suggests there's economic fundamentals driving the market.
Yep.
And Dr. Copper says, yep, all good. Again, has been worried for a while, but lately it's now. We don't need to worry anymore. And I think this would surprise a lot of people is just Citigroup have a cyclicals defensive index, again, has a nice long history, and cyclicals continue to outperform defensives. So you've got a US economy where unemployment's been creeping up, certain leading indicators like delinquencies and home building permits don't look great. But at the same time, it's been a funny cycle in that the things that look a bit ordinary have been bleeding out, but hasn't really precipitously fallen. And I think ultimately it's because COVID was such a disruptive shock, and we're still working through some of that. So the share market is clearly happy with the economy.
Yep.
The only thing that's quite odder, I think, is the consumer. And much like here, right, the consumer is not a happy consumer. And a big part of that is inflation. The last time I went to America, when the Aussie had around 70 cents, which is reasonable, nothing in America is cheap. Like, it's an expensive place to live. So I think the consumer is really ground down. On top of that, unions aren't as strong as they used to be. You got the gig economy, you got inflation, and you got geopolitical risks. And it's interesting to see the market disconnect from the consumer because, again, I'm going back to 2000. It never really has disconnected to this extent. And is it because people are so enamored with AI and the productivity benefits, and they're not really thinking that the consumer matters anymore? Or I don't know why there's this big disconnect cost.
My opinion on this, Gino, is I feel despite the US consumer and consumption being 60% of GDP in the US, I feel like the stock market isn't really the economy anymore. And the CEO, and I've always thought the CEO optimism is because they've got levers that they can pull, whether cost-cutting exercises or laying people off. It still drives margin expansion. And you've actually shared with me many months ago a good chart. We don't have it today, but the return on equity that companies generate has doubled in 50 years. And it just shows you that the stock market is the economy and its EPS is not the GDP, as we learned from a few of our strategist friends. That's why I believe the market continues to go higher. There's the optimism of the market, and the retail punter still thinks that you got to buy the dip because taco.
That's right. And you can see in some ways you can read this as saying consumers really downbeat. Are they trying to make money through the market? Are they taking on more risk because they just feel so bad? They feel like I need to do something to make money.
Yeah. Okay.
I think so. So what I'm saying is, I guess that things look fine. There's some leading indicators that don't look great, but haven't looked great for years, and don't seem like they're really ever gonna roll over. The market is definitely convinced that the economy is fine. They've priced out rate cuts to the tune of 150 basis points, and still the market's holding up.
Yeah.
I guess the only issue really is that Roosevelt said, I think fear is fear itself. And I think it's just a huge amount of complacency now in the market. And I think that's really the big risk. So this is a put call ratio. Again, going back to 99, you can see obviously put call ratio is very low in the .com bubble. It'd be crazy to short the market. But again, the correlation is high. And generally when put call ratios are low, nothing good happens. And that's a 12-month forward return, 3 months leading, is flagging negative returns at some point.
Okay.
Or it could be another taco moment where people go, gee, I was worrying about nothing.
Yeah.
The other chart I've got here is the CDX, which is the credit default swap spread. I guess what I'm saying here is that the thinner line is the CDX. So when that spikes, there's been some sort of risk event. So January 12, you're probably rolling off the Euro debt crisis. Then obviously had COVID, we had the QE, taper tantrum. So generally you have a spike in CDX, people worried about credit, they're worried about markets. And then if calm heads prevail, you actually have really good returns in the market following a period of panic, which to your point is buy dip. Buy dip has worked. Again, what's very unusual is that since really 24, CDX spread, credit default spreads have been very tight by historical standards. And yet the market continues to power ahead. So it's not like we're bouncing off a period of risk or we're bouncing off a period of weak economic growth. We're just plowing ahead. Things are good. Just keep going. So this is unusual as well.
Yeah. Is it a function also of the amount of liquidity that's still in the system?
I don't know. I think I'm a huge fan of Matt King from Citi, who's now gone off to Sartori. Even he, I think, he was always a big proponent that liquidity drives markets, but I feel like he's also backing away from that. I feel like no one's been able to really explain the mechanism to me, how that central bank liquidity makes its way into markets, other than the fact that there is no alternative, the tenure. But how do bank balance sheets, you buy treasuries off them, okay, then how does that make its way to equity markets? We know hedge funds are much more leveraged. We know hedge fund leverage has gone up like 2.5 times, and actually the Federal Reserve is pointing it out as a bit of a risk into the insurance companies. So there's more leverage in the system, that's for sure.
Yeah, that partly explains what happened in Japan last year and the way that
All it's true.
crypto assets performed over the last 6 months. It just feels, to your point, there's a lot of leverage in the system. And yeah, this probably is a great segue, Gino, then to move across to say, how does active management help protect investor capital because of all of these risks? So you've always noted that the future is uncertain. So how do you think about what you do, which is different to what traditional managers?
We're very different. Again, I purpose-built. It took me a year to develop what we do in the process and the systems. And we're still evolving. We're big believing in continuously evolving. So it's very different. I guess the first tenet of what we believe in to be diversified. So we have what we call an investment pool, which is a group of companies which we follow and we intend to follow over the long run. And you see here, we're just very diversified by industry. So we're not taking bets on particular industries. We've got machinery, biotech, building product, you name it. We're looking to just get a really nice diversification. We don't really care about the index weights. We just want diversification across the economy.
So do you look for the best stocks in the sectors and then allocate capital? How do you identify the opportunities within that?
We have what we call a V6 framework, and that very much lends itself to how we go about discovering. So this is called a discovery fund. So we're not looking at market cap per se. We're looking at companies that aren't that well covered.
Yes.
So we're trying to find companies that aren't that well covered by the sell side, and we work at Citi together. So what happens, I would initiate on a stock. I'd come down to the desk and present it to you. And then the desk would try and muscle in on the floor, and they'd organise meetings with fund managers, and you go from there, right? And it creates this whole interest in pushing the stock. So why not ride that wave? So we're trying to find stocks that at the most of, say, 10 analysts covering them. And some of these stocks have no analysts covering them. And we'll get in there and ride the waves when people discover it, when brokers initiate. Our biggest stock's about US $40 billion. So we're actually not in the mid-cap space. We're very much in that small-cap space.
Okay.
Because it's a discovery fund. We're looking to find companies before others do. And then,
But what's the minimum amount that, Gino, that you start with, like market cap?
the minimum can be low, but we want liquidity. We like to be able to get in and out of position very quickly. So that's really the only constraint.
Okay.
So, we will go down to 500 million US.
Okay.
But as long as it's liquid enough, like we want to get in and out within a couple of days tops.
Okay.
So we're looking for the best. Not necessarily. We definitely abide by this V6 framework. So this V6 framework is, again, we've designed for long-term investment. I think companies with these V6 attributes have a higher propensity to capitalize on their potential. So what are the V6? Industry structure. Every fund manager says it, but it is important. And I think the way we look at it is unique and is very detailed. But that's very important. Now, the thing is, if we look at industries like consumer, they're actually pretty bad industries.
Yep.
But we will still own something there for the diversification benefits.
Okay.
So we'll still own industries that aren't great to get that diversification. Then we care about returns. Cash flow, return on capital is the king. Again, a lot of managers say it, but we've embedded it. We want high cash flow returns. What I call optionality, which is really balance sheet strength. I think a company that's got a lot of gearing has just got less options. Whereas if you've got a great balance sheet, yeah, I'll buy that CapEx, I'll buy that company. You've got the option to capitalize on your ideas. Management, we don't try and judge management. I think that's a fool's game. I think it's very hard to judge management from the outside of a company, having been within one. So we purely look for tenure.
Yep. And track record. Yep.
Yep. We also care about ownership. And so there we like a cornerstone investor, maybe another company, maybe a group of families, maybe a founder. We don't really care as long as there's someone that it means few of our companies get taken over, but it means they can be long-term in their thinking. They don't have to panic if the share price is weak.
Yep.
They can take a longer-term view. So in the short term, it's probably a bad thing in that we don't get those M&A, those sweet hits from M&A. But in the long run, we think we own better companies for it. And then the last one is really runway. We want companies with runway. So either the market is growing, they can continue growing, or we can see obvious adjacencies or new products. So we want runway. So does that mean we end up with the sexiest company? No, not necessarily. Sometimes we do. We think we've got some really exciting companies. But sometimes it means we've got a company where others may not be putting as much weight on what we do in terms of ownership and tenure and returns, if that makes sense.
It does. So tell us a little bit about some of these sexy companies then you've got, Gino.
One of our favorites is, in terms of sex appeal, is the Rambus. So Rambus is very strong DDR5 memory. So this is very high-end memory that goes into data centers. We're not talking about the RAM you'd have in your PC at home. This is RAM that's used by data centers. American company, very strong each there, and obviously very strong demand. In software, we still own Sectra, which is like the Swedish equivalent of Pro Medicus.
Okay.
Amazing management team. CEO owns about 20%, and another founder owns about 20%. That has these very high-end encrypted satellite phones for NATO.
Wow.
And they have what they call venture funds. So they'll do things like software for orthopedic surgery. They'll do software for medical training. They have an incubation segment as well. So they're not a pure play like Pro Medicus. But Sectra is actually not that expensive and actually is being destroyed on this software AI. We didn't own it, and we bought it actually near the bottom. So the system did very well to do that. And we still own quite a lot of it.
Okay, interesting. You mentioned the system. How do you identify these opportunities, Gino?
So having identified the V6, we then model the company, we do an investment thesis on the company, and then we then meet with the company at the back end of the process. So we don't meet up front, we actually meet at the back end. And then once we agree that the company is worthy of getting the investment pool, we add it in. If not, we relegate it to non-investment grade. Once it goes into the investment pool, we actually have a systematic process that builds a portfolio for us. The logic there, Rob, is I worked for 4 different managers, I think, and every one of them, the portfolio construction is really around sitting around the table deciding what to buy and what to sell. It's very
Yeah.
So this introduces maths. Everything's back tested, takes emotion out of it. And one company we love is Eventum. Eventum is a German company. It's effectively the European equivalent of Live Nation.
Okay.
So they control the ticketing, events. massive barriers to entry, great returns, really good company, but we haven't owned it because the system said no, you can't own that. If I didn't have the system, I'd own a bucket of it because it's a great company. It's not that expensive.
So why did the system reject it?
So the system can reject it on, this is a sort of a simplified schematic of the system, but you can see the system looks at valuation. In the case of Eventum, it was probably momentum. So we have a momentum indicator, and the momentum indicator was said no. We also look at earnings trend. So if companies are having a soft patch in earnings, we just pull back. And then we also have factors like growth and size. And ultimately what we're saying is, look, we like these companies over the long run. They're all great companies, but none of them is going to go bottom left to top right in a straight line. Every company goes through patches and periods and wobbles. And so the system's about just saying, okay, when things are a bit iffy or tough, well, we're just going to sit back. And when the company's shooting goals and everything's humming, we'll be there in size. And again, it's mathematical, it's quantitative, it's systematic. So there's no emotion. And sometimes it tells us to shoot stocks we love, but too bad.
Yeah. And so how many stocks would be in the portfolio?
So in the investment pools, we aim to have about 80. We're currently at about 76, 77. And in the portfolio, we've got about 28 stocks.
Okay.
So that'll vary. The system sometimes will want to own 60% of the pool. Sometimes it will want to own 35% of the pool. That depends on these factors effectively. And then, sorry.
I was going to say, putting this all together, we agree when it comes to data and using it to complement what you're trying to achieve, but how has the data helped you in your processes, helped you with performance?
Yeah, so I like to peer myself against not so much the MSCI, but against other managers. So anyone with a unit price on Bloomberg that's a sort of small mid-cap manager, I peer against. And our returns have been the most steady by far. So they've been very steady. We had a bit of a drawdown in 3Q reporting season. It was a bit odd. But other than that, we've been really consistent. And then we've got hedging, which has detracted a little bit of value. Excluding that, we're second to Munro, who are an excellent manager and done a great job. And I think your clients are in there. So the performance has been good, but I think ultimately we're going to win over the long run because of that consistency, because of that discipline. And we haven't even seen a different cycle, but we are set to perform in a value cycle. We're set to perform in different sorts of cycles. I think that is what's going to really matter over time.
So it's a bit of an all-weather, small, mid-cap kind of thing.
It's all weather. It's designed to do post-GFC, post.com, through .com. It's because, as I said, I'm a child of that generation. I'm always expecting the next GFC of .com. And so this is designed to weather it and actually do well out of it.
It's fun. We're obviously the same. So many investors of the last 2.5 decades have just experienced markets going one way, which is up. Big support from financial markets, i.e. central banks, but then also inflation going our way. And suddenly we might be at a point where we've got stickier inflation. And I think the market's underestimating those risks. So what are some of the other risks that you think that the market might be underestimating?
To say, Rob, I'm worried about inflation because I haven't experienced it in my career either, actually. My whole career, I started with Greenspan. We've never really had high inflation as a problem in my career. So I'm worried that if that comes around, I can study history, but I've never actually been through it. So that worries me a bit.
Yep.
I think I'll just show you this chart as well quickly. So we're in a period where, as I said, the economy is doing well, markets are grinding higher, the complacency is very high. But it also means that because the market keeps grinding higher, nobody wants to know about stuff that's not going to deliver returns today. Yeah. There's not going to double in the next year. And we've got these stocks in our investment pool, turnarounds, value, and the market just doesn't care. Some of them, in our opinion, are like half what they should be. But the market just does not care because who's going to buy them?
So to your point, are these stocks that you've highlighted, 10 stocks bar chart saying either turnaround or undiscovered or value within healthcare, financials, consumer discretionary, industrials, IT. Do you believe that some of these companies are uncovered, i.e. from research side, or just that there's the free float of the companies is too low for fund managers to look at, and you're just seeing that there's value in these businesses where they got huge growth and they're just cheap?
With combinations, so Undiscovered, I've labeled Undiscovered, where they're a pretty big company, but there's only 2 or 3 analysts covering them, and they're still on a pretty big PE. I just think they're cheap because not enough people have really come across them. So our second one there is a company called Scan. It's a Swiss company. They make isolators for biopharma. So basically, in the past, you'd used a clean room, but even in a clean room, it might be 1 parts per million of bacteria. Whereas with these isolators, they're absolutely sterile. And so you need them to do, particularly biopharma, where you've actually got live antibodies and things. And they fabricate this custom build. Really good business. Owned by, I think, 3 Swiss families. This is in China. But it's not cheap. I think it's 18 times P or something. It's clearly undiscovered. It's really cheap on a DCF basis and when you value it.
Yeah.
But then you've got other stocks where they're valued, i.e. they're trading on 10 times PE, cash flow's great, balance sheet's good. Yeah, they'll grow 5% and nothing exciting. When you value them, it's, wow, this is super cheap. But no one cares.
Yeah.
There's no momentum there. So the important thing is these stocks are in their investment pool. So when the time comes that you want to switch from growth momentum to value, we're covering them, we know what they're worth, and the system can switch.
Yes. So this in effect is, as you said earlier, a really diversified portfolio across growth stocks, turnaround value across different sectors as well. It's all about compounding over time, for patient investors.
Yep.
As you highlight, the subject heading on that chart is the market has no patience, but exactly what your philosophy is on how you allocate capital to investors.
Exactly. Now, in terms of risk, sorry, because I didn't answer that question. I think the risk side, obviously, the economy is still going well in the US, but you have seen unemployment trough and pick up. Pretty rare for that not to keep going. My view is, and we have a hedging framework, as you alluded to, when 2 things that are apparent, which is the yield curve is flat, US yield curve is flat, and investor sentiment is high, you've got trouble. You've got risk. Doesn't mean tomorrow, doesn't mean in a year, but risks are high. And that's the case now. So our hedging framework has been quite skittish. We hedged in March 25, so we picked up the April tariff, which is good. Means we hardly fell. In fact, we went up as the market fell. And then again, it got very skittish around September, December, so we were hedged going into Iran. But we've also been hedged through the back half of 25, and that cost us.
Okay.
The point is we're very skittish because of those 2 conditions are met.
And does your system tell you to hedge, or does this like just the human overlay?
No, it's back tested back to 1984, but even earlier, I think, maybe even late 70s. So it's a process that's been back tested back to 1980s. I think if you're picking up the Financial Times and saying, oh my God, you're in trouble.
Yeah.
There's just so much noise. So this is a system that's been built. We've got 2. So we've got an OG system. I call it OG because it's the original. That flagged in March. And then I've got a beta, which flagged in February, which actually did a better job, and September, and then again in December. But I think we're pretty much closing that out because whenever you have these sort of pullbacks, the market refreshes, and it's very unusual for the market to roll over again once it's had this sort of pullbacks.
Yep, they look through it, don't they?
Yeah. I mean, I think the key risks are those, we're late cycle. And we were talking earlier about AI. AI is risky. It's funny, China released V4 DeepSeek, and I've not heard any news about that. But China still remains a very viable competitor in AI.
Yeah.
Using Huawei chips too.
Yeah. It'll be interesting how it all plays out, Gino. And so if we can just sum it all up, if you wanted to give one message to those listening that might be interested, what kind of philosophy, fund manager do you want to portray yourself as?
I think ultimately we're not here to suit everyone. We're not here for people planning on their retirement. We're here for people have a bucket of money that they want to pass on to future generations or an endowment or something like that. So it's built for those investors. And in so doing, we're very differentiated because we do a few things. We enhance beta because of our factor tilts. We follow these companies over a very long period and also help protect the downside with our hedging. So all those things are geared to, because my view is people with a lot of wealth are actually more scared of losing it than the average person. Like they're actually, because they've worked hard for it and they know how hard it is to get.
They don't need to take the risk anymore, Gino.
And they don't need to take the risk. Exactly.
Yeah. But they're still going to grow, but they don't want to take the risk.
Exactly.
All right. And so those listening, where can they learn a little bit more about Vestigo?
Well, we're actually pretty clandestine, to be honest. We like to be under the radar.
You are very much under the radar.
We are under. If you go to our website, there's a paywall for our investors. Because my view is, again, we're very targeted in who we want to help, which is people that are a bucket that is intergenerational. So really, if people are interested, please contact you and you can funnel them through directly. But yeah, we write an investor letter, quarterly investor letter to our investors. If people are interested, I could put them on that as well. But we're focused on just investing and building a good track record. And then you'll probably hear a bit more about us in the coming years.
You've done that so far, Gino. So congratulations on what you've built, because to your point, it is very differentiated to others, given the hedging and the systems and the way you approach investment and your thought process. So congratulations on that. I'm looking forward to reading and learning more about the business. And so, Gino, thank you so much for your time today.